Hi, and welcome back to the fifth in our series on the economics of foreign exchange and exchange rates. Last time we looked at the demand and supply for Australian dollars, and we noted that things can go wrong because they're not like normal demand and supply curves. They're derived demand curves and derived supply curves. In this video, we're going to go into a couple more explanations to see that in fact demand for Australian dollars does slope down and supply does slope up, and we can be pretty confident of that. So just a reminder, the demand for Australian dollars is simply the sum of export demand, income receipts paid to Australia, and foreign investment in Australia. And the supply of Australian dollars is imports, income payments by Australia, and foreign investment by Australia. And we showed last time that things might go wrong if we just concentrate on simple imports and exports story. This time we're going to start by looking at the foreign investment story. And we're going to ask what happens for demand and supply for Australian dollars when the exchange rate changes from the perspective of an investor. Let's consider a hypothetical investor. Her name is Sunita, and she has $1 million Australian to invest for 1 year. She has two options. The first is to buy some Australian government bonds. Now they pay 5% interest. The Australian government isn't about to go bankrupt, so they're safe, and they're denominated in Australian dollars. Sunita's second alternative is German government bonds. Now, the German government is also not going to go bankrupt, but they only pay 2% interest, and they're denominated in euro. Now, Sunita lives and works in Australia, so she wants to get Australian dollars at the end of the year. So there's two additional bits of information that Sunita needs to decide which investment she'll make. She needs to know the current Euro Australian dollar price, or the current Euro Australian dollar exchange rate. And she will also need to have an expectation about what she thinks the Euro Australian dollar exchange rate will be in a year's time. Because if Sunita decides to invest in the German bonds, she's going to need to change her 1 million Australian dollars into euro to buy the German government bonds. It'll be foreign investment by an Australian. And then at the end of the year, when the German government pays her back her principal for $1 million plus her interest for 2%, she's going to have to get that payment in euro and transfer that euro back to Australian dollars so that she can spend it. So let's say that Sunita expects the euro Australian dollar exchange rate in 12 months to be 0.60. In other words, she thinks that it'll be 0.6 of a euro to the Australian dollar in a year. Now, which investment will Sunita make? So now we can work out the best investment for Sunita. Let's start off by saying today's exchange rate is 0.66 euro to the Australian dollar. If Sunita puts her $1 million into Australian bonds, she gets 5% return over the year. So at the end of the year, she will get 1.05 million Australian dollars, or in other words, 1,050,000 Australian dollars. But what does she expect to get if she buys German bonds? Well, given today's exchange rate of 0.66, she can take her 1 million Australian dollars and buy 660,000 euro. The German government bonds will pay 2% interest, so that will give her 660 times 1.02, or in other words, 673,200 euro in 1 year. But she has to change them back to Australian dollars. And she thinks that the Australian dollar exchange rate in a year's time will be 0.6 of a euro to the Australian dollar. So that means that her €673,200 in a year will be worth, well, 673,200 divided by 0.6 of a euro to the Australian dollar gives us 1,122,000 Australian dollars. So, if we move our working just to one side over here, we can see that the choice for Sunita is pretty clear. Given the current exchange rate, 0.66 euro to the Australian dollar, given her expectation of the future exchange rate, which is 0.60 euro to the Australian dollar in a year, if she buys Australian government bonds today, she expects to have 1.05 million Australian dollars in a year. But if she sells Australian dollars today, buys euro and buys German government bonds, she expects to have 1.122 million in a year. So given her expectation about the future exchange rate and given today's exchange rate, Sunita will sell Australian dollars and buy the German bonds because they're the better investment. Okay, let's try another one. Let's imagine though that instead of the exchange rate being 0.66 today, let's imagine the exchange rate today is only 0.6 of a euro to the Australian dollar. If Sunita buys the Australian government bond, she still expects to have 1.05 million at the end of the year. But if Sunita buys the German government bonds, well, she first has to change her $1 million Australian into euro. At this exchange rate, 0.6 euro to the Australian dollars, she can only buy 600,000 euro, so she can only put 600,000 euro into German government bonds. The German government bonds still pay 2%, so at the end of the 12 months, she expects to get a cheque from the German government for 612,000 euro. But she needs to change that back to Australian dollars. But remember, Sunita expects the exchange rate to be 0.6 in a year's time, so those 612,000 euro that she gets from the German government can be exchanged back to 1,020,000 Australian dollars. So if the exchange rate today is 0.6 euro to the Australian dollars, then Sunita believes that if she buys German government bonds, she will only make an extra $20,000. But if she keeps the money in Australia and buys Australian government bonds, she'll make an extra $50,000. To see what's happening here, note that Sunita, if she invests her money in German bonds, gets a return in two ways. First, she gets the 2% interest on those bonds. But secondly, she gets an extra return if the exchange rate moves the right way. Now, at an exchange rate of 0.6 today, and given that Sunita believes the exchange rate will be 0.6 in a year, it's an easy decision for her. There's no gain in the exchange rate, so she can either get 2% in Germany or 5% in Australia. She'll keep her money in Australia. She won't supply Australian dollars. But if the exchange rate's higher at 0.66 euro to the Australian dollar today, then Sunita believes that she'll get her return two ways. She'll get the 2% on the German government bonds, but she'll also get a gain because she believes that the Australian dollar will fall in price. Or in other words, she believes the Australian dollar is currently overvalued. So she's willing to supply Australian dollars today, buy the German government bonds, because from her perspective, that's a better investment. Notice that this means the higher the exchange rate, the greater the willingness of Sunita to supply Australian dollars and buy euro. But that's exactly what we need for the supply curve to slope up. And we don't need all the investors to be the same as Sunita. Different investors will have different beliefs about the future exchange rate, the future value of an Australian dollar in terms of euro. But regardless of what those beliefs are, the higher today's exchange rate, the more likely they believe that the Australian dollar is overvalued, and the more willing they are to sell Australian dollars today because they believe that they will get a better return by investing overseas. and so that drives the supply curve of Australian dollars up. A higher exchange rate means a greater supply of Australian dollars. So we now have a second reason as to why the supply curve of Australian dollars will go up. It's due to people making investment decisions based on their expectation of the future exchange rate. And by the way, we get a downward sloping demand for exactly the same reason. People in Germany are making the same decision that Sunita is making, but from their perspective, the lower the exchange rate, the better it is to sell euro and demand Australian dollars. So as the exchange rate goes down, they believe the Australian dollar is undervalued and will demand more Australian dollars to buy Australian government bonds, expecting to get the interest return and the exchange rate return over the next year. Now let's change direction a little bit. Rather than focusing on demand and supply, let's go back to focusing on tradable goods and services and ask about what that says with regards to the long-term exchange rates. Suppose that you are an apple importer into Europe. You can source your apples from two countries, Australia or New Zealand. Now the price of apples is different in Australia and New Zealand. The price of apples in Australia is 5 Australian dollars per kilo. The price of apples in New Zealand is 6 New Zealand dollars per kilo. Other than that, the apples are identical and it costs you the same amount to transport apples from New Zealand to Europe, from Australia to Europe. So which apples are you going to buy to import to Europe to sell to your customers? To work out which apples are cheaper, we need some exchange rates. So let's say that the exchange rate is 0.66 euro to the Australian dollar today and 0.60 euro to the New Zealand dollar today. At these exchange rates, the price of Australian dollars is $5 per kilo times 0.66, the exchange rate, or 3.3 euro per kilogram of Australian apples. And the price of New Zealand apples is $6 New Zealand per kilo times the exchange rate, 0.6, or in other words, 3.6 euro per kilo of New Zealand apples. So the apple importer at these exchange rates is going to choose to buy Australian apples, transport them to Europe. Why? Because they're cheaper from the European perspective. Of course, to buy the Australian apples, the European apple importer has got to get some Australian dollars, so they need to sell euro and buy Australian dollars. So they will be part of the demand for Australian dollars. But what if the exchange rate changes? Let's suppose that the price of an Australian dollar goes up to 0.75 of a euro per Australian dollar. Well, at the new higher price of Australian dollars, to buy the $5 needed to buy a kilo of apples will now take 5 times 0.75 or 3.75 euro per kilo. So now the apple importer buying apples for Europe will prefer the New Zealand apples because now they're cheaper at 3.6 euro per kilo. The Australian apples now cost 3.75 per kilo. So notice what's happened here. As the price of an Australian dollar has gone up, the apple importer has decided not to buy Australian apples, but to buy New Zealand apples, and as a consequence has decided not to buy or not to demand Australian dollars. The importer is going to buy New Zealand dollars instead. So as the price of an Australian dollar goes up, the demand for Australian dollars from European apple importers will go down. We can apply this model more generally to all tradable goods and services. And this gives us the so-called purchasing power parity theory of exchange rates. That says that in the longer term, exchange rates have to move so that the price of a bundle of tradable goods is going to be the same no matter which country you buy it from. And if that isn't the situation, then there's going to be a fall in demand for the more expensive country. That will lead to a reduction in its exchange rate to return the exchange rate to equilibrium. So this is a long-term prediction about the exchange rate. Now, in our simple example here, the PPP, or purchasing power parity exchange rate for apples, would be 0.72 euro per Australian dollar. At that exchange rate, both Australian and New Zealand apples cost 3.6 euro per kilo, and the apple importer from Europe will be indifferent as to which country's apple he or she buys. The PPP theory is more general in that it applies to all imported products, and it also applies over the longer term. So let's summarise. We've now seen that we can be pretty sure that the demand for Australian dollars slopes down and the supply slopes up, driven by foreign investment and investors having different expectations about future exchange rates. We've also seen one possible predictor of future exchange rates, the purchasing power parity model of exchange rates. Now we can return with confidence to our demand and supply diagram and start analysing the consequences of economic policies on exchange rates, imports, exports, and see what happens. But that's for next time. Thanks for listening.